of the Chamber of On behalf of the Chamber of Tax Consultants, I welcome you all participants as well as our learned speaker and our moderator in the group discussion, in the panel discussion, which the subject is the tax audit. We know all the practicing chartered accountant and legal fraternity are busy in the tax audit, which is we have to complete within the next couple of weeks. But this topic is such that there are many issues here. And in order to discuss the issues here, we have the eminent panel and a moderator for this purpose. I wish this program or this webinar will be fruitful and beneficial for all the participants here. And to give the brief of the Chamber of Tax Consultant, I would like to say that the Chamber of Tax Consultant is a 97-year-old, or we are going to complete our 100th birthday. It is around 100-year-old organization based on Bombay. And I am here along with team, Harpreet ji, Siddhartha Bhattacharya sir, all are representing the Delhi chapter here. And with this short message here, I am handing over this proceeding to our colleague Harpreet ji for the brief introduction of all the esteemed panel member and the moderator, and taking the session forward. Thanks a lot. Thank you, Harpreet ji. Up to you.
Yes, thank you, Prakash ji, and good evening to everyone. I, on behalf of Chamber of Tax Consultants, welcome you all for this webinar. This webinar would be presented by 3 speakers and a moderator. 3 speakers' names are Mr. Deepak Chopra, Mr. Sargi, and Mr. Sachin Sinha. The session would be moderated by Ms. Smita Patni. So I'll briefly introduce Mr. Deepak Chopra first. Deepak Chopra is a fellow member of Institute of Chartered Accountants of India and has graduated in Commerce from the Bangalore University. He qualified as a Chartered Accountant in the year 2011. He has a strong passion of direct taxes and has been regularly taking classes for students of company secretaries and Chartered Accountants course. He was a regular faculty member of Bangalore branch of ICI for direct taxes for students of CA Final. He has also been a resource person on direct tax matters on various forums, including at Bangalore, Mysore, Chennai, Hyderabad, and various other South Indian cities. He has been a resource person for the session hosted by the Committee of Members in Practice. He has also been faculty for officers of Income Tax Department at the Direct Tax Regional Training Institute, Bangalore. He is presently serving as a chairman of the Direct Tax Committee of Karnataka State Chartered Accountant Association. So I welcome Deepak ji on behalf of Chamber of Tax Consultants.
Thank you, sir. Namaskar. It's an honor being at CTC platform. Thank you for calling me.
Yes. We welcome you, sir. So next, I will now introduce Ms. Advocate Pankaj Saraugi. Pankaj Saraugi is a chartered accountant from 2007. He held 10th rank in CA finals and got highest marks in direct tax law in NIRC of ICI. He has graduated from Sri Ram College of Commerce. He is a chartered accountant turned advocate and is practicing into litigation, advisory, and compliance. He has vast experience in direct tax laws. He holds diploma in international taxation and was a special invitee of the Direct Tax Committee of ICI for the year 2018-19. He is an eminent speaker in seminars, workshops, and trainings on the direct taxes organized by ICI, PSU, and corporates. I welcome Pankaj ji.
Thank you, Harpreet ji. Thank you.
Yes, we welcome you on behalf of Chamber of Tax Consultants.
It's my honor, sir. It's my honor.
Yes. So now I'll introduce Mr. Sachin Sinha. Mr. Sachin Sinha he has a long profile. He is a fellow member of Institute of Chartered Accountants of India, having around 20 years of experience. He is a founder partner of Prakash Sachin and Company Chartered Accountants. He has in-hand experience of taxation in domestic and international taxation and management consultancy. He has developed himself in advisory and litigation in handling other commercial issues. He has handled various assignments of advisory, litigation, and compliance both in direct tax and international tax. He has completed various certificate and diploma courses of ICAI, including international taxation, transfer pricing, auditing and taxation of non-profit organization, audit of banks, forensic audit, fraud detection, and also a course of IFA on international taxation and transfer pricing. He has deliberated in around 400 seminars and webinars so far on the topic of domestic and international taxation, and has written many articles on the same subject for various knowledge portals, including taxman.com. He is a member of the study group of Direct Tax Committee for the year 2020-21 and member of the group formed by ICAI for writing revised guidance note on tax audit. He is also a member of the International Tax Committee of ICAI for the year 2021, 22, 22, 23 and Direct Tax Committee for 23, 24. He is a special invitee in the study group of International Tax Committee of ICAI, CP Committee of NIRC, Executive Committee of IFA India, Research Committee of International Taxation, visiting faculty on International Taxation, faculty of ICAI for Diploma on International Taxation. He has authored many books for ICAI on the topic of tax audit, permanent establishment, Form 15 CACB, and background material for UAE corporate tax. He's a member of the group formed by ICAI for UAE taxation. He's a visiting faculty of UAE branch of ICAI to deliberate UAE corporate tax, and he is also secretary to the Northern Region chapter of IFA branch for the year 2023 to 25. Welcome Sinha on this topic on behalf of your tax consultants. So he has written about guidance not on tax audit. So it's an opportunity for all of us to ask him various questions and clarifications. Right. I welcome you, sir. Now, our moderator is Smita Patni. Ms. Smita Patni was enrolled as a member of ICAI in the year 1999, securing 44th All India rank in CA Intermediate, and has a vast experience of around 24 years in almost all the facets of accounting profession. Her core area of expertise is international tax and FEMA-related matters of the clients. She has also been a special invitee in the Committee of International Taxation of ICAI. She is also part of that Tax Committee of ICAI as an expert for the current year. She is also a proactive member of the Executive Committee of IFA Northern Chapter and CTC Delhi Chapter. She is a regular speaker, moderator, and group leader in various webinars and has many articles published in her name, and has contributed to many publications, which recently including contribution in ICAI publication on technical guide on fees for technical services and royalty, and background material for certificate course on UAE corporate tax. She has also recently contributed to the ICAI Tax Audit Guidance Note 2023. So I welcome you, ma'am, on this very interesting topic. This is relevant all. And now over to you for moderating this session.
Thank you so much, Harpreet. Thank you so much. And a very good evening to all of our star members and panel members. So at the outset, I welcome all the panelists on behalf of CTC Delhi chapter and profusely thank our chairman, sir, and the organizing committee for providing me an opportunity to moderate this session on this evergreen subject of tax audit through this eminent platform. It's indeed an honor and a privilege. Given the onerous responsibility of signing tax audit report makes us accountable, and in order to discharge this responsibility, we should conduct this audit with due diligence and high accuracy. During our deliberations with our panelists, for the day and our star speakers. We would like to focus on the basics of the tax audit report and would like to make an attempt to analyze and bring about subtle nuances hidden in the layers of Section 44AB, read with other sections of the Act. Now, without any delay, I would share the PPT and start the session. So is it visible?
Yes, ma'am.
Yes, it is.
You can make it full screen
Full
if you want.
I'll do it as F5, I think. Yeah, I'll do it. So the very first question is to Sri Pankaj. So the ICI has issued guidance note 2023 on 4th September 2023. What are the substantial changes made in guidance note 2023 versus guidance note 2022? Over to you, Pankaj.
Yeah. Thank you, Smita. And first of all, with regard to our chairman of the CTC Delhi, Prakash sir, and co-speakers for the day, co-panelist, and my professional colleague Harpreet ji. So good evening to all and all the participants. And friends, before going into dwelling into this particular question, I would like to address one particular thing that we like, for example, the participants which you are on the CTC platform. I know that on the CTC platform, only those professionals dare to join who are quite serious for their towards the profession. But as the like senior professions, we can say it's our owner's duty to educate to the at least to the junior professionals who have recently qualified in next 5 or 10 years, if I talk about that, we all believe that the NFRA has authority over only those professionals who are doing audit of listed companies. But friends, for those listed companies, I do not think so that they are having authority only for those years from which particular date that NFRA has been notified or has been created. They are looking after the old audits also. And same could happen over the period of time when they are give the authority to look after the audits of the unlisted entities. And in that case, we have to take care of that. So that it is quite possible that the audits we are doing for financial year 22-23 would be in the domain of the NFRA in the near future. So we have to be serious enough. And specifically, we all CTC members, it's our owner's duty to educate the other professionals so that they take their assignment very seriously as independent professional and doing proper reporting. And friends, if I go by the changes, substantial changes which have been made in the guidance note 2023 vis-a-vis guidance note 2022, we will find out that many changes are there which says that even in the guidance note that as professional, we have to apply our professional expertise or judgment. Like specifically in case of section 28.4, if I talk about whether any particular incentive or received by the company or the businessman, whether it constitutes kind of section 28.4 income or not. So even in the guidance note, they have specified, use the words that the professional requires expertise and the application of the mind. So these kind of substantial changes are there in the tax audit. To add on to that, if I talk about, like for example, they have put an onerous duty over us that in case of reporting requirement of TDS deduction under clause 24, if I'm not 34, if I'm not wrong, that we need to check whether the TDS compliance has been made through form 26 capital A or not. We all know that particular provision section 2011A. In that there is a safeguard in case we forgot to deduct the TDS and in case the deductee pays the income tax due on his income and declared it in ITR and filed the ITR. To that effect, we can have a certificate from a chartered accountant. Now that constitutes the compliance of the TDS requirement. So in that case, it has been specifically written in the guidance note that we need to check that form 26 capital A. Although in practical life, I do not think so that will be feasible. Reason being, if I talk about if I make a mistake or my SSC has made a mistake by not deducting that particular TDS in financial year 22-23, obviously that deductee is going to file return in this particular period only. It is quite possible he may have furnished the return by 31st of July, but in case maximum SSC, if I talk about due date is 31st of October. How can we have form 26 in that particular case? So that is a practical challenge, in my opinion, if I talk about. Another thing which like you can say the very fine change, if I talk about in respect of reporting of brought forward loss or depreciation. Friends, till date, we used to report that brought forward loss or depreciation on the basis of the ITRs filed. And if any change is there on the basis of the assessment order or CIT appeals order or higher authority order, we used to report to that. But this time they have used the word that even we have to report whether assessment is pending or not in respect of that particular year. That means they want to have kind of data through the form 3CD that the department knows each and everything that on the date of signing of the tax audit report, whether any particular assessment was pending or not, whether it could have any impact over the brought forward losses depreciation or not. And friends, this comment is required even if whether that assessee is claiming set off of that particular loss or not. That does not make any difference. So these are some examples of the substantial changes. And I think with the questions which are coming through the mentor and through the participants, we will discuss other changes at that time also. So that's all from my side at this particular instance. Over to Smita.
Thank you so much, Pankaj. So next question. So this is for Sachinji. Section 20, this is related to section 28 subsection 4 versus turnover. So section 28 refers to income. However, the test criteria for section 44 AB is turnover. Whether section 28 talks about or states the net of expenses, that is income, or is there any other criteria? Please elaborate. Thanks. You are not mute.
Sorry. So thank you so much, ma'am, for this question. As Pankaj has just deliberated on slightly touched upon this aspect. If you see section 28(4), while talking about the turnover, because section 44AB says every person carrying on business and the sales turnover gross receipt exceeds 1 crore rupee and so on. So if it means the test criteria is the turnover, if you say, and if the criteria is turnover, then whether it is defined or not. So frankly speaking, in the statute, it is not defined what is the meaning of sales turnover or gross receipt. Now come to section 28(4), which says the income, which talks about the income. So the following income shall be chargeable to income tax under the head profit and gain. And it includes section clause 4 also, which says the value of any benefit or perquisite. So it means if the person has received the benefit of perquisite during the financial year 22-23, it means it should be considered as income as per section 28(4). And we are testing the turnover as per section 44AB. So to my mind, there is difference between the turnover and the income. So while we are talking about the income, it is of course net of all expenditure, and then we said it's an income. But the guidance note in clause number 5.12, it says specifically covers this point and says the value of any benefit or perquisite, it would be considered as the turnover. It means assuming during the financial year 22-23, the assessee has received 1 crore as a perquisite, section 28(4) says it's an income. However, the guidance note says it's a turnover for the purpose of testing the threshold of turnover for the purpose of 44AB. So of course, there is a gap in this, and this needs to be clarified. But as far as concerned to 28(4), of course, it talks about the income only. So any other view, the other panelists?
Yeah. If there is any other view, then please would request any of the panelists to speak on it.
I think Sachin sir has given the perfect view. If I talk about nothing more, in my view, is nothing left behind that particular aspect.
So we move on to the next query, and this is for Deepakji. For various purposes, figure of turnover is required. That is applicability of tax audit, profit and loss account, clause 40 ratios, and portfolio management services. So criteria to calculate turnover is different for applicability purposes, as we all know. Whether these figures must be same or could be different, and how to reflect the same in the tax audit report.
Thank you, madam, for this question. So a pretty lengthy question. I'll just break it into parts. I'll take the PMS aspect of it first. Now, before getting into the turnover of PMS, let's take a step back to analyze that very taxability of income from PMS. Now, the nature of income from transactions in shares has been an unsettled litigation since ages. It was way back in 1975 that Supreme Court in Sutlej Cotton Mills told us that whether income from transaction in shares is capital gain or business income is a mixed question of fact and law. To me, it's a vexed question of fact and law, which is unsettled even till date. Specifically dealing with income from PMS services, there have been varying judgments from Mumbai Tribunal, Ahmedabad Tribunal, and Pune Tribunal on this issue. Some tribunals going with the view that this is taxable under the head capital gain, and some going with the view that it is taxable as income from business. The rationale behind capital gain income being that this is a one-time investment activity. So at the beginning of the scheme, a one-time investment of 50 lakh, 1 crore is made, and the funds are left to be managed by the portfolio manager. There is some follow-up activity, there's some reporting, there's annual reporting and all of that, but then it's a investment activity and the income is chargeable to tax under the head capital gain. But then at the same time, there have been judgments from the very same Mumbai tribunal which have gone on to hold this to be a business activity. They have gone into the volume of turnovers, the volume of transactions that the portfolio manager carries on to manage your fund, and the courts have gone on to hold that this activity of buy and sale which the manager carries on behalf of the investor is nothing but the investment activity, or rather a business activity of the investor himself. He is often only an agent, and the turnover or the transactions belong to the principal himself. So it's a organized and systematic activity aimed at earning profits. So it's an adventure in the nature of trade or commerce, and it has been held to be business in nature. So whether business or capital gain is a call that you'll have to take with in discussion with your clients. If the call taken is that this is a business activity, only then it would form part of your Form 3CD. Then in all these cases, it's seen that the portfolio manager would provide you with an audited statement. It will have a detailed P&L and it will have a detailed balance sheet giving you income details, giving you the transaction details as well. So the income details given to you in the audited report would have to be adopted in your books of accounts as is. So the turnover as he is reporting in the audited statements would be your turnover. That's my personal view. And that is the turnover that you would not just capture in your books of accounts in your P&L account, but also in the uh, Form 3CD as part of clause 40, where you report the turnover, net profit, and other particulars. So at least with regards to PMS, I don't see any variance with regards to turnover adopted for applicability of tax audit and turnover reported as part of tax audit report. Uh, we have seen in some instances where different turnover numbers are adopted by SSCs for derivative transactions. Now, for derivatives, as we know, the turnover is sum of all positives and sum of all negatives. That's for the applicability of tax audit. So in the P&L, all the positives appear on the credit side, all the negatives appear on the debit side, and most SSCs would take the number appearing on the credit of the P&L as the turnover for the purpose of clause 40. But in my humble view, for the purpose of clause 40 also, the turnover should again be the sum of debit and credit as it appears in your P&L, and this view finds support in the guidance note of ICI as well. So in the guidance note, in the guidance to this clause 40, ICI with regards to turnover once again makes a reference to the discussion of turnover that we have at the very initial of the guidance note with regards to applicability of tax audit. So in my practical view, I have never come across a scenario where the turnover for adopting or applicability of tax audit is different from the turnover that you report under clause 40 of Form 3CD. There may be differing views from the co-panelists. I would.
Yeah, Deepak, I differ in this particular aspect as a part of practitioner. If I talk about, and obviously, when obviously we are all here because of that. Obviously, interpretational issues are there. If there are no interpretational issues, if the law is very black and white, obviously we would not be chartered accountant or doing CA practice if we talk about. So, like for example, like one of the changes that we are told about regarding guidance note 2023. So what I have read in that may be my interpretation, that they have written kind of the interpretation that this computation of turnover of derivative transactions, that is addition of losses and profits, is only for the purpose of determination of applicability of tax audit. So that is my interpretation, that gives the apprehension that is the turnover from the perspective of the books of accounts of clause 40 may be different from the determination of applicability. So that what we are following in the actual practice even itself. So it depends, but we have never faced any kind of challenge from the department whether you have reported wrong or not. So the time will tell, or the Honorable Supreme Court will tell whether how it is going to be reported.
I
Yes.
concur with the view of Pankaj because even we have been following the same practice, though this is a new, since yesterday's discussion with all the panelists, even this Deepak ji's view is quite fascinating and we will think over this over the time. So next question. So next is for you, Sachin ji. There are a lot of queries on 44AB, so I'll take it up. Before the specified date, this is on the specified date, that clause before the specified date. So section 44AB says the assessee gets his account audited before the specified date and furnish such report by that date. So whether the assessee is required to obtain the same on or before the specified date. Sachin, for you.
Oh, thank you, ma'am. So if we, when we read section 44AB, so after all the clauses A, B, C, D, E, it says the get his accounts audited, get his accounts of such previous year audited by an accountant before the specified date and furnish that report by that date. It means it talks about two things has to be done. First, you have to obtain the audit report from the auditor before the specified date, and you have to furnish by that date. So which date? That is specified date. So what is the meaning of a specified date? In the explanation itself, they say that a specified date in relation to the accounts of the SSC of the previous year relevant to the assessment year, that date is the due date of furnishing of the returns. So 1 month prior to the due date of furnishing of return. So assuming we are considering an individual SSC having turnover more than 10 crore. So due date is 31st of October. That is under section 139(1). So 1 month prior to the due date, it means 30th of September. It means the specified date as per this act is 30th September for the purpose of the SSC I have just taken in the example. Now it says that it is to be obtained before the specified date. It means the audit report has to be obtained before the specified date, not on or before the specified date. It means you have to obtain the audit report at least on 29th of September and not on 30th of September. So this is my view, and if other panelists can differ from this view.
I don't recall the judgment, the citation, but then I recall reading a ITAT judgment wherein before the specified date, before 30th September has been interpreted to mean before the midnight of 30th. Of course, it's certainly a avoidable litigation. It may be a prudent practice to get your audit signed off by 29th of September rather than take the risk of getting into litigation. But then that view also exists, is just what I wanted to bring to light.
Yes, there are court laws favoring this view that 30th September should be considered as the, date. But I agree that, 29th September would be, on a safer side, you can go with 29th September.
Yeah, the fact that there are case laws on this goes on to say that 1 day of dispute has led to litigation traveling way up to ITAT.
Yeah.
If feasible, certainly avoidable litigation.
So next question over to you, Deepakji. As tax auditor, does the scope of audit extend to the personal books of the assessee as well?
Now, this is a question relevant for auditees who are individuals or HUFs. So we quite often see auditees, individuals or HUFs carrying on business, having separate business books and separate personal books. So the question here is, as a tax auditor, what is my scope of audit? Am I limited only to the business books of the SSC, or should my audit travel beyond the business books, and should I also be examining the personal books of the SSC? Now, from years of practice, we all know obviously the answer is that I have to restrict myself to the business books of the SSC. And on this very point, there is a very interesting judgment of Bombay High Court in the case of Ghai Constructions, wherein the Bombay High Court did an in-depth analysis of the provisions of Section 44AB. It went into Rule 6G. It in fact went and analyzed the committee's report, which was constituted in 1970, which in turn led to the introduction of tax audit provisions in the Act. And Bombay High Court has categorically concluded in that case that tax auditor is under no legal obligation to go beyond the business books of the SSC. Now, the relevance of this judgment of Bombay High Court could be in the cases of instances where there are some GST or income tax proceedings, surveys, searches, and the assessee has been identified as carrying on any unaccounted transaction. Now, in all these cases, there is a defense available to us now that those are transactions carried out outside the business books. The scope of my audit is strictly the business books of the SSE. What the SSE does outside his business is beyond my scope, and I'm under no legal or professional obligation to be reporting on those transactions. It can also come to use in cases where the SSEs and the bankers of the SSE pesters the CA for a certification on the personal books, on the personal balance sheet of the SSE as well. A lot of times we see, the personal balance sheet along with the business balance sheet serves as a basis for his loan being sanctioned. So in all those cases, we can be relying on this judgment to say that this is certainly beyond our scope. And as a matter of professional prudence, I would also suggest that this be a part of our observations in the Form 3CB, to say that, to very clearly indicate or to communicate to the reader of the audit report that the scope of my audit is purely business books of the SEC and not the transactions which are outside the business books of the SEC.
And if I can add to that, I think we should always, when we are taking the engagement letter or MRL, we can add that point there also that, our books are limited to that. For example, there are 10 bank accounts and he just gives us 7 bank accounts and say there are 3 more bank accounts which are related to, say, savings account. So we can, I think, give that disclaimer and we can add it in the engagement letter itself that, our audit, and in the management representation letter also we can take the same, that our audit is limited only to the business. Whatever.
So I want to add something here. This problem generally comes when you are taking care of the individual SSC.
Yeah.
Because sometimes they do the transaction, the personal transaction through the books of accounts, the business books of accounts. So generally we have seen that they made some investment through the business books, or make some LIC payment, or ULIP, or making some investment for personal investment purpose. But it is routing through the books of accounts, so business books of accounts. So whether in such cases the auditor is required to report on those part or not. So technically speaking, as you have mentioned, that is, since you are auditing for the purpose of business, so it should be confined to the business. But sometimes if the transaction is routed through the business books, then even though you want or not, but I think you have to report at least to that extent that this is routed through the business books. So this is my submission.
Perfect, sir. And sir, in this regard, one particular change I'm getting in my mind, which have been made by GN 2023, or I will not say the change, the paragraph they have deleted. The thing is that as tax auditor, do we have power to ask for the books of accounts from the assessee? Like if we talk about the Companies Act, that gives the power, clear-cut power, that as a stat auditor, we can ask for the books of accounts. And if we talk about the Guidance Note 2022, it used to give the reference that as auditor, we have power to ask for the books of accounts of the, in respect of business only, from the assessee. But this time they have deleted that particular paragraph at all. Now, what does that mean? The deleting that particular paragraph. Do we have such power? Obviously, the tax audit sections or provisions of the income tax law does not talk about such kind of aspects at all. So in my particular view, when the CA Institute TAQRB has deleted that particular paragraph in the guidance note, so we should have like engagement letter or the scope letter. If we talk about in that particular letter, we should have a clear-cut power with us that we can ask for the books of accounts or the supporting documents, each and everything, so that we are fulfilling our tax auditor responsibility fully. So that is one of the substantial change. Ma'am, you are on mute.
They have mentioned in the guidance note also that you should have an unrestricted access to the books of accounts, plus additional information you can ask them anytime. And plus, basic books obviously should be there with you. These 3 parameters are there in the ICA guidance note, in addition to what you are saying there. So coming to next question, Pankaj, for you only. Whether the assessee can revise the tax audit report and the PS under what circumstances?
Yeah, ma'am, very relevant question. If we talk about, the thing is that we professionals are using this particular aspect very leniently of revising the tax audit reports. Obviously, the power is there. And if we talk about the power, first of all, we know that as on date, every power is through like IT. If the IT of the system of the income tax portal permits, that power is there. If it does not permit, then no power is there. But I do not think that is a true picture. Obviously, if the law permits something, we can have that particular power through court of law. No doubt. Now, regarding the revision of tax audit report, the rule 6G of the income tax rules permits that particular, that you can revise the tax audit, but it provides only 2 situations if we talk about. And the 2 situations are that if the assessee has made payment of the TDS after the date of signing of the audit report, but before the due date of ITR, And because of that particular delayed payment of TDS, disallowances are there under section 40 clause A, subclause I or subclause IA. Or similarly, if we talk about section 43B, which talks about that if you are making the payment of expenses on or before due date of ITR, you can claim those expenses on accrual basis or actual payment basis if we talk about. So friends, on those two particular instances, and that is very practical enough if we talk about, because it is quite possible that SSC has made the payments after the date of signing of the audit report, but before the due date of ITR of, that is 139(1) due dates. Now, what about other situations? Like other situations could be amalgamation. Generally, the approval is required is the backdated. If we talk about it, maybe backdated like 2 years before or 1.5 years before, and it is quite possible that amalgamated company may have filed income tax returns and tax audit reports up to that particular date. I think that is one of the warranting situation which requires revision of the tax audit report, but it should not be taken leniently. Reason being that, frankly speaking, the tax audit quality review board is selecting tax audits for the purpose of the review, and so that to find out the common mistakes which we are making and can address them. Obviously, the CA should also permit you to take actions. So friends, obviously, in my view, the tax audits which have been revised will be a separate sample or a separate group from which samples will be selected. So non-warranting reasons we should not revise, considering that it will benefit the SSC. We should think of first ourselves. Second thing, should we go for revision of the tax audit report even in the situations of TDS 40AI or 43B without any engagement letter or without any communication from the SSC? Obviously, no. Friends, if we have completed the audit, for example, today on 15th of September, our work ends. It is not my responsibility as an auditor to upload that particular tax audit report. I have uploaded after that, not my responsibility whether that particular SSC accepts that or not. Secondly, whether he files a return of income or not. Unless and until the SSC communicates to me that I have made those particular payments, I cannot revise that particular tax audit report. So we should have a particular, you can say, paragraph in the scope of engagement that this does not include revision of tax audit reports under any circumstances. And for that purpose, you need to approach us separately. We should have proper documentation, proper each and everything, why that revision is warranted from the assessor's perspective. Then only we should revise, otherwise not. Although that computer system, if we talk about, is not asking the reasons in detail or is not restricting any kind of revisions at all, it generally happens that why you are revising, but it is not checking as such because there is such note chat GPT AI till date if we talk about.
So Pankaj, if I can add one pointer from CA guidance note, it is this year they have changed this and they have said that in case of there are any recalculations in 40 AIA oblique 41 and 43B, then it is mandatory for the auditor to revise the tax audit. That is one thing. Secondly, in addition to that, ICA guidance note has also given 3 more grounds which they are saying that, in case the stat auditor has adopted a revised balance sheet at the time of AGM, then the tax auditor is supposed to revise his tax audit report. Secondly, in case of there is any change in interpretation of law, by any retrospective amendment, then you are supposed to revise your return. And the third ground which they have given is that in case of there is any change in circular or change in statute, or change in law because of some judgment, Supreme Court judgment, then you can revise your tax audit. These are the 3 grounds which have been given by the institute, but mainly they have made it mandatory for in case of 43B and 40A.
Ma'am, in that particular case, my interpretation differs little bit, because if we talk about the guidance note 2022, it says it is not mandatory to revise in case of 43B or, and now this time they have not said mandatory, they have deleted that particular paragraph and left for the interpretation. In my view, if anything is deleted, we cannot interpret the law other way around. That it is totally turned down in that other aspect. Now it is open for interpretation whether it is mandatory or not. But obviously we can revise, but only on the request of the SSC and not our suo motu revision should be there.
So in the same situation, Rule 6G Clause 3 says this report may be revised. So this is whether it's what the ICI says it's mandatorily to be revised. However, the rule says may be revised, and that too only 2 situations which Pankaj has already covered. These 3 situations, what you have mentioned that already in the guidance note, that is not matching with the act or rule. So I don't know how it will sustain in the court of law subsequently. But as of my understanding, Rule 6G, Clause 3 says it's may be revised, and that too only in those two cases. And this amendment was from the year 2021. But as Pankaj has also said, that the system allows you to revise it, and the department is accepting it. However, there is no law earlier regarding the revision of tax audit report. And similarly, the acceptance and rejection of report, the law does not talk anything about this. But practically speaking, when the auditor furnished the report, it went to the portal of the SSC and says accept or reject. I don't know under what capacity the auditee can reject this report. I don't know.
I certainly concur. I was only given the reference of ICI guidance note, so that is how it was there. So I thought just to bring it to your notice, and you.
No, we totally agree with you, ma'am. Since you were one of the contributors, so we are highlighting this point.
Thank you so much. So coming back to the next question, which is for Deepak ji. Whether income from agriculture receipts, agriculture products shall be liable to tax audit under Section 44 AB if it crosses the threshold limit.
On a lighter note, मैडम, भारत के किसान का आप टैक्स ऑडिट करेंगे बवाल हो जाएगा. बंदे को रिटर्न फाइल करने की जरूरत नहीं है, आप उसको 44 AB में घुसाएंगे, it will be a huge trouble. But then I understand where this question is coming from. This question again has its genesis to the amendments made in the guidance note.
Yes.
So earlier versions of guidance note used to have a specific paragraph dealing with this issue, wherein ICI had taken a stand that for agricultural income which is exempt under Section 10(1), tax audit requirements are not applicable. Now, for some reason, I think you will be in a better position to explain as to why ICI has now omitted that paragraph, leading to a speculation that is there a change in law? Am I now required to audit in such circumstances? Now, to answer this, I will take you to a 2002 Bombay ITAT judgment in the case of Magnum India Fund. So, Magnum India Fund was a mutual fund whose income was exempt under Section 1023D. And Magnum India Fund was issued served an order under 271B, levying penalty for failure to get a tax audit done, and the matter travelled up to ITAT. Now, Bombay ITAT very interestingly observed that under 1023D, the income being totally exempt. Now, where is 1023D? 1023D is housed under Chapter 3, which reads incomes which will not form part of income. The items which will not form part of total income. So, when an item of income is exempt under any of the clauses of Section 10, the ITAT was of the view that nothing of it, the provisions of PGBP would not be applicable at all. No part of PGBP computation enters your final income, and therefore there's no requirement to do a tax audit. So possibly this ratio can be applied to all other incomes which are exempt under Section 10, and a safe conclusion can be made that in such cases a 44AB audit is not required.
Yes, thank you. I think even
and I want to add something. So in guidance note also, in 5.13, they have covered that agriculture receipts are out of this total turnover part.
what I wanted to say, right?
But then, if I may add on to this discussion, what happens? So, with regards to incomes under Section 10, we have a direct Bombay ITAT judgment shielding us, blessing us. Now, what happens to incomes that are exempt under 11, 12, 13? Now, in my personal view, this ratio of what was said to us by Bombay ITAT and Magnum India Fund would equally apply to incomes that are exempt under 11, 12, 13 also. But then, interestingly, ICI in its guidance note with regards to charitable trusts tells us to get the business books of accounts audited under 44 AB, which again, in my humble view, would not be an accurate presentation of law. For the reason being, it's 11, 12, 13 is a self-sustained code in itself. Income of a trust which is computed under Section 11 does not fall under the heads of income do not apply to that income computation at all. So the heads of income not being applicable, PGBP chapter itself not being applicable, there is no scope of importing 44 AB into it. See, wherever the law required certain provisions of 44 or PGBP to be applied, for example, 48.3 cash payments in excess of 10,000, TDS disallowance. So some of the provisions of PGBP have been specifically imported into Section 11. Now, 44 AB not having been imported into Section 11, even for trusts who have some business activities, 44 AB provision should not be applicable.
So, sir, if you carry this ratio, considering that in case of exempt income or the income which is not forming part of the total income, this should not be applied. Then of course, then how to taste the entity on which the section 10 AA applies, or because assuming that it's an SEZ unit, and of course it's a conditional exemption. If you have to export, then you will get the exemption. But it says that it is in chapter 3 that not forming part of total income, but it is carrying on business and the turnover may be more than 10 crore. In that case, of course, the tax audit is required because it is carrying on business and the turnover is more than a specified limit. So as per my understanding, this ratio, to the extent applicable, where the agriculture income exists, but whether it should be applies to every transaction of chapter 3, I differ to that extent, sir.
So,
Just to counter
in
that,
the
on behalf of assessees, 10AA has always been on a slightly different footing. Is it an exemption section or a deduction section has been a dispute for ages. So maybe that can be made an exception to the applicability of this ratio, but otherwise, uh, I would still want to take that stand or shelter of saying that where your income is exempt under Chapter 3, 44AB should not be applicable. See, the idea of 44AB is to verify your business income. Now, if the entire business income itself is exempt, then there's no use or no productive purpose of doing a 44AB audit.
Okay,
got it. So there is a question also in Q&A box, which is saying that whether state share in profit of LLP versus firm, which is exempt under section 10, will be counted for the purpose of threshold limit of tax on the same lines.
Okay. Yeah, Neha, you are talking about the profit. The question arises not only in respect of the profit, but also in the respect of the remuneration or interest drawn by a particular partner from the partnership firm. And I think that principle is very much settled and settled by the recently in 2022 by the Bombay High Court also. That in any case, the partner is not carrying on business in his personal capacity. Whatever the business is being carried on in the capacity of the partnership firm, which is separately subject to the tax audit and maintenance of the books of accounts. So from those perspective, if we go by anyone by the Bombay High Court judgment, that partners remuneration, partners interest, and obviously the partners profit share would not be counted for the purpose of determination of applicability of tax audit at all. So profit in any case is exempt by section 10. Even remuneration and interest also, I think in my view also, that should be excluded for the purpose of determination of tax audit.
Yes, yes. We have a question also for that, and Parijat is the case which you are referring to.
Yeah.
So next query is for Sachinji. So if an assessee is doing business and profession both, and if his professional receipts are say 51 lakhs from the specified profession and his business receipts are say 86 lakhs, whether section 44AB is applicable on both on specified profession and business, or tax audit is applicable only on a specified profession.
Okay. So in the case study, what you have taken, the professional receipt is more than 50 lakhs. So of course, 44 ADA is not available and will fall under the under clause B of section 44 AB. So of course, tax audit will be applicable to that extent. And subsequently, the business receipt is 86 lakhs, which is less than 1 crore. I'm not testing the 5% criteria now. So it is less than 1 crore. So whether the tax audit is required or not. So while reading section 44 AB, it says every person carrying on business and the sales turnover gross receipt exceeds 1 crore rupees. So 44 AB to that extent not applicable as per my understanding. 44 AB clause B is applicable. However, in the guidance note, they have given the concept of drag along, and it says if the SSC is carrying on business or profession, and if in one case the audit is required, then in the case of the SSC per se, the whole tax audit is required. But I beg to differ to some extent, because the law never says or never gives such a combination. It says only the 5 criteria, and it's all compartmental based. So A says if you are carrying on business and the sales turnover gross receipt exceeds 1 crore rupees, you are liable for tax audit, assuming on not testing criteria of 5%. And clause B says if you are carrying on profession and the receipt is more than 50 lakhs, then the tax audit is required. So to my mind, do the tax audit for profession, and for business, tax audit is not required.
Are there any divergent views on it?
I think that is the view only, in my opinion also. that only profession is required to be audited, professional books and not business books, because these are independent provisions.
So I have one question on it, that then in that case, whenever there is a divergent view from the ICI guidance note, which we are as seeing over the time, that we have different views, which is not concurring to the ICI guidance note, and we always, the first thing which we are preached and we told is that we should follow our ICI guidance note. So then in that case, what should be the approach of taking such questions or such type of, if you can throw light on this.
So in many cases, you'll see that the provision which is given in the statute and the guidance which is given by the ICI may not be matching, or it's a your professional judgment that what you want to take, because assuming the statute is to that extent clear, then you can say I'll follow this, but and you at the same time you have a guidance that have a persuasive value to the extent guiding you. So take the guidance to that extent, but if you have supporting judgments, or if you have some different view, you can take that view with your interpretation. This is my understanding. Yes, Deepak sir, please.
I think it's a matter of convenience. Both sides are equally wrong and nobody's equally right and nobody is wrong here. Audit करना है तो guidance note है, audit नहीं करना है तो सिन्हा सर का advice भी है, तो both places you are not wrong.
Okay. You are on mute, ma'am. You are on mute.
Yeah. So, sorry. So this question is for Deepak ji. Whether a person is required to maintain books of accounts under section 44AA1, even if he has opted for presumptive taxation under section 44ADA. One, I would say there also 44ADA.
The requirement for maintenance of books of accounts flows from 44AA. Now, subsection 2 talks of general books of accounts applicable for all SSEs wherever the turnover exceeds 10 lakhs or the income exceeds 1.5 lakh, to be read as 2.5 and 25 lakhs in case of individuals and HUF. So wherever these turnover or income thresholds are reached, there is a requirement to maintain general books of accounts. Now 44AA has a specific requirement for maintenance of certain specified books, ledger, cash book, journal, daily case register in case of medical professionals, and this requirement is applicable only to specified professionals, doctors, lawyers, chartered accountants, and so on and so forth. Interestingly, 44AA does not give you any relaxation. There's no income or turnover threshold also, barring a small turnover based or a gross receipt based threshold that we have under Rule 6F. So proviso to Rule 6F sub rule 1 tells you that if your gross receipt is less than 1.5 lakh, which is a very small amount, if the gross receipt is less than 1.5 lakh, then these specified books need not be maintained even by a specified professional. So under 44AA standalone, there is absolutely no relaxation with regards to non-maintenance of books of accounts. If you look into 44ADA, the 44ADA subsection 1 talks of the presumptive rate of 50% on the gross receipt if your turnover or the gross receipt does not exceed 50 lakh. If you have to jump to subsection 4 will tell you that if you are an SSE who has gross receipts less than 50 lakh, but who's willing to offer to tax income at a rate less than 50%, then you will have to get your books of accounts, you will have to maintain books of accounts, and you will have to get your books of accounts audited. We'll have to appreciate that the law at no place tells us that if you're following 44 ADA, you don't have to maintain books of accounts. It rather negatively tells us that if you're offering income at a rate lower than the rate given to you under 44 ADA, then you will have to maintain books of accounts. So by way of this negative interpretation, one can possibly draw a inferred conclusion to say that where my income is less than 50%, I will have to maintain books of accounts. Where my income is 50% or higher, I will not maintain books of accounts. And fortunately, this kind of a approach has the blessings of the parliament by way of a clear express wording in the memorandum to the finance bill, and again in fact endorsed by the CBDT also. So the CBDT circular, the circular 3 of 2017, which goes on to explain the various amendments brought in by Finance Act 2016. Finance Act 2016 is where the 44 ADA provision was inserted. There also very categorically they have told that a SSE adopting presumptive scheme under 44 ADA will not be required to maintain books of accounts. So I think it's a safe conclusion to say if you are entering 44 ADA, you don't have to worry about books of accounts.
The only question which I have, Deepak ji, is that Finance Act being a memorandum, so can we use it as an interpretation to aid or interpretation to law, or we can use circular as binding to us, or since law is very clear that we need to maintain books under 44 ADA subsection 1 because it is only getting us away from the audit and not from the books. So what
The
should we do?
circular 3 of 17 would be binding on the AO. So this is a question that we can ask between us, but certainly not the AO to ask us. And this, conclusion also has the blessings of tribunal. So Chandigarh tribunal in the case of Nandlal Poparni, and there's a Bangalore ITAT in the case of Gokarne Prabhakar, in the context of 44 ADA, not 44 ADA, but then the ratio can equally be extended to 44 ADA. There again, there's a categorical finding to say that a person following presumptive scheme will not maintain books of accounts.
Thank you so much. So next question is for Sachinji. Can an assessee claim both presumptive deductions under 44 ADA and 44 AD at the same time?
So
Simultaneously.
44, yes. So 44 ADA and 44 AD. This is a very interesting question because whether this both can be taken at same time or not. So while we read section 44 AD, clause 6 says the provision of this section notwithstanding anything contained in the following provisions shall apply to a person carrying on profession as per 44 AA. So if the person is carrying on profession and 44 ADA is available to a person who is falling under 44 AA, it means 44 AD is not available to them. So to my mind, both section cannot be adopted in the same time because 44 ADA, if you are following 44 ADA out of 44 AD, or if you're a profession, even though you're taking 44 AD or not, you are out of 44 AD. You are on mute.
So we go with the next question. So this is for Pankaj. I'll just read it by the time I shift it. In clause 8 of form 3CD, there is a requirement to select one of the options regarding applicability of the tax audit. Which option is required to be selected in different scenarios in case of business entity in both of the cases of form 3CA and 3CD? I'll just shift the slide.
I got your point, Smita.
Yeah.
The Smita, the confusion. Yeah, I got your point. The Smita, the confusion arises because of the language which is being used as part of Section 44 AB, and the language which is used in the drop-down menu or the options provided in Form 3CD. So first of all, we have to see the fine-tuning of the language, the words used in the Section 44 AB itself. That says that tax audit required if business turnover is more than rupees 1 CR. But proviso to Section 44 AB clause A simply says that if the cash involvement regarding receipts and payment is within 5% of the total receipts and payments, then this 1 CR should be read as 10 CR. So the word used is that if the cash involvement is up to 5% or does not exceed 5%. But when we go by the language which is used in the drop-down utility of the Form 3CD, focusing upon that the screen you are sharing on the very first option and the last option. Like first option simply says total sales, etc. of business exceeding specified limits. Now, what is the specified limits? They have not specified here. And the last option says proviso where aggregate cash receipts and cash payments of business exceeding specified limits. So that says ki your receipts and payments are exceeding specified limits. That means exceeding 5%. Now, the question arises if the turnover is more than 10 CR, whether we have to select the first option or the last option. The first option. Obviously not the last option because we are not doing audit because of the reason of the cash involvement more than the limit. But the thing arises when we read the 44 AB clause A of the section that says tax audit is required in case turnover is more than 1 CR. But here this particular first option is selected when turnover is more than 10 CR. So that's the confusion is because of the language used. So if turnover is between 1 CR to 10 CR, then clause 44 AB A proviso need to be selected. So that we have to take care of. And obviously, while generating UDIN for the purpose of this particular tax audit, we should be clear at the time of UDIN also that the same option is selected there even. Now, this particular scenario, if I talk about, is for Form 3CB. Now, coming to Form 3CA, like best example, a company which is liable for stat audit also. So then Form 3CA need to be filed. Now, which particular option is required to be selected? Whether it is the first one or the second last or the last one. If I talk about that house, obviously for the majority of the persons, I will get the answer that it is the second last option. That is third proviso to section 44AB, that is audited under any other law. And I agree with that. No issue in that. Even if we go by the guidance note issued by the ICI, that says the same thing, that we have to select third proviso to section 44AB. But my question to the house is that if we select this particular third proviso to section 44AB, we are giving the indication or the information that why we are filing form 3CA and not form 3CB. But that is in itself clear. If we talk about form 3CA, that start with that particular paragraph only, that the books of accounts are already audited under any other law. Are we giving the indication by this particular form that why the assessee falls under the picture of section 44AB? Not at all. By selecting only the second last option, that picture is not at all clear. Friends, if we go by the utility, there is the option of adding the rows in this particular selection also. That means we can select more than one options that why under which particular clause audit is there. In that particular case, in my opinion, in form 3CA, there must be two clauses which we should select. One, that is third proviso to section 44AB. And second, if in terms of business, if I talk about either the first one or the last one, whether turnover is more than 10 CR or turnover between 1 to 10 CR with cash involvement more than 5%. Now, the another question arises in that particular case, which one first? Which one first? Now, as per the guidance note, obviously we should follow the guidance note. That first option should be third proviso to section 44AB only. And while generating UDIN, we can select only one option. So that option should match with the first option, which we are putting in form 3CD. But second option should be either of the first one or the last one. In my personal opinion, if I talk about, the picture should be other way around. First of all, we should communicate to the department by form 3CD that why the assessee is under the picture of section 44AB, and then we should give the that opinion or the written declaration that why form 3CA is filed and not why form 3C is not filed. So that is the clear picture. If I talk about, there is a clear-cut option of add on the top of the utility where you can add the rows. So obviously that is some purpose is there while providing that particular option in the utility. So that's for my side. If anyone particular view of Sachin sir or Deepak sir or even ma'am also in this particular aspect. So
I agree with you. It is, I mean, very, very well explained. Very well explained. So we go with the next question. So I just ask the question. This is for Deepak ji. Can there be a scenario when ICDS is not applicable to a company?
ICDS, madam, as we all know, is mandatory to all SSEs, barring only two exceptions. Exception number one being individual or HUF who is not subject to tax audit, which obviously is not a case where a company can fit in. The second exception is for an SSE following cash system of accounting. So the question that needs to be answered here is, can a company follow cash system of accounting? Now, the initial answer that any professional would give to this question is no, because a company is bound by company law. Section 128 of Companies Act mandates every company to follow, maintain its books of accounts under accrual system of accounting. So the initial blush, the answer seems to be no. But then if you give a read of section 145 of the Income Tax Act, section 145 of Income Tax Act gives an unconditional option to all SSEs to either follow mercantile system of accounting, which is the accrual system of accounting, or the cash system of accounting for the purposes of computing income under the head PGBP and income from other sources. But there is nothing under 145(1) restricting a company from not opting from cash system of accounting or mandating a company to follow accrual system of accounting. But then the question that next arises is, how do you resolve this conflict between 128 of Companies Act and 145 of Income Tax Act? Is 128 of Companies Act going to override 145 of Income Tax Act? The answer again would be no. There is a middle way out wherein you can resolve this by satisfying the requirements of both the sections. Assessee can, as a practice, for the purpose of compliance under company law, maintain its books of accounts under accrual system of accounting, present its financial statements before the shareholders under the provisions of Companies Act following all the accounting standards as are notified under the company law. But when it comes to his income tax return, when it comes to his income computation statement, a company is within its legal income tax rights to compute its income under cash system of accounting. It is very much possible that I do accrual system for company law and cash system for income tax law, and this arrangement is blessed by Calcutta High Court in the case of Pradeep Commercials, Hyderabad Tribunal in the case of Chennai Finance, and also Mumbai Tribunal in the case of Struck Consultants. So by getting into cash system of accounting, you can escape from the clutches of ICDS. You're on mute, madam.
So any other view on this? So I go with the next question. So method of valuation of closing stock employed in the previous year in case of deviation from the method of valuation prescribed under section 145A and the effect thereof or on the profit or loss, please furnish. So this query is for Pankaj. The impact of section 145A is required to be reported in this clause. Since long enough impact is treated as tax neutral, is it really tax neutral?
I got your point, Smita. Friends, we all know that section 145 capital A talks about the method of accounting, obviously not for the purpose of books of accounts. In practical life, assessees, if we talk about, follows exclusive method of accounting and do not include GST specifically if we talk about in the figures of purchase or sales or in the figures of closing stock at all. But section 145 capital talks about the inclusive method of accounting, which talks about that purchases, sales, closing stock, everything need to be included of inclusive of GST, whether any kind of input is available or not. Now, prior to GST, if we talk about, we used to have excise. And friends, there is a difference between excise and GST. If I talk about, excise is the trigger point of leviability of excise was the date of manufacturing. But the trigger point for the GST, if we talk about, is the date of sale. Now, if there is a closing stock, I'm just taking a very small example. If we talk about, for example, during the year, I made purchases of 10 units of rupees 100 each. That makes total purchases of rupees 1000. And for the sake of simplicity, I'm assuming GST rate to be 20%. For the sake of easy calculation, so that we can appreciate the particular aspect. And I'm assuming it is altogether new business. That means there is no opening stock at all. That means 1000 rupees purchase plus 200 rupees GST. In exclusive method of accounting, we will debit 1000 rupees to the trading account. Now, out of that 10 units, I'm selling off 8 units for rupees 150 each. That means my selling price will be 1200 rupees on the revenue side of the trading account, plus rupees 240 GST, which is I'm going to charge from my customers. And there will be a closing stock of 2 units. And from the perspective of books, the valuation of the 2 units will be rupees 200. I'm ignoring that particular aspect of net realizable value at this particular stage. So that means if we go by the exclusive method of accounting, there will be a debit side with 1000 rupees debit. There will be a credit side with 1200 rupees credit as sales and 200 rupees credit as closing stock, resulting into 400 rupees of gross profit. And in this particular case, there is no expenses at all. The net profit will be equal to gross profit, that is rupees 400. Now coming to the perspective of the 145 capital A, it says that GST need to be included as part of purchases. Now, for example, if I'm going to maintain books of accounts on the basis of inclusive method of accounting, in case, I'm just assuming, so that in that case, purchases will be debited to the account of rupees 1200. Sales will be accounted for rupees 1200 plus 20% GST, that is 1440. And there will be closing stock of 200. And if I include the GST, it comes to rupees 240. And on that basis, if I prepare the trading account, I'm coming to that particular question which you may be having in mind. That coming to that particular aspect, the trading account will result into gross profit of rupees 480. 1440 plus 240 minus 1200, resulting into 440. Now, to the government, I need to pay GST equivalent to rupees 40 only. Output tax 240. Input tax will be available on 100% of the purchases, whether they have been sold or not. So that means I have to pay 40 rupees to the government as GST, which will be debited to the P&L account, resulting into net profit of rupees 440. In my view, this results into increase of the profit by rupees 40 because there is a closing stock which is more than opening stock, and on that GST impact is rupees 40. Now, in that respect, the first question which arises, whether closing stock is to be valued at rupees 200 or at rupees 240. Friends, this particular dispute is there, but this dispute I can say to be valid only when if I talk about the closing stock constitutes of finished goods. Whether closing stock would include 40 rupees of GST or not. Now, for example, assuming this particular example, I'm doing the manufacturing aspect, purchasing the raw material, same prices, each and everything. And at the year end, I'm having 2 units of raw material costing rupees 100 each. In that case, my view is that the closing stock of the raw material need to be inclusive of GST. It cannot be valued at rupees 200. In any case, it has to be valued at rupees 240 in this particular case, resulting into increase by of rupees 40. Although this will be a timing difference because current year closing stock will be the opening stock of the next year. And in support of that, recently gone through our CTC publication only. Friends, it's a very amazing publication. And first time in my life, I have seen that how the journal is being prepared. Literally, every clause they have discussed in that particular journal of the CTC of tax audit, and every type of issues have been accounted for. And even in that particular journal, the question has been raised whether it is tax neutral or not. Now, friends, why that particular question is coming? That's the question. Because, friends, if we go by the guidance note of the ICDS since 2014 and then 2022, then 2023, friends, in 2014, we used to have numerical examples in the guidance note itself, which says that it is tax neutral in itself. But in 2022 and 2023, they have deleted that particular numerical example at all, but they have provided a simple paragraph in which they have written that impact of 145 capital A is tax neutral. But how it is tax neutral? That's the question. And I think this question can be answered if we ask someone that what is going to be the general entries in case inclusive method of accounting is followed in books of account. So in my view, it is not tax neutral, but still we are following the policy. Obviously, guidance note is there. So as professionals, if we talk about, we are safe enough. But in case the department, or you can say awakes, so that could be a problem for many assessees who are into manufacturing or trading business. So it results into earlier recognition of income as compared to the books of accounts if we talk about. So that is my particular view in this particular aspect.
Deepak ji, any contrary view? Sachin ji?
Yes.
I rather have a query. ये CTC का publication income tax department को तो नहीं भेजते हैं ना? Very long. It has been imbibed in our DNA, in our blood कि ये tax neutral है. Supreme Court ने भी Berger Paints में, Indo Nippon Paints में मान लिया है. ये CTC वाले क्यों ऐसे department की favoring बात लिख रहे हैं on the later note? But I would still want to, I'm still lost in the numbers a little. But पंकज जी ने एकदम डिटेल में बताया है, तो we'll have to do some head scratching to find a way out of it.
Deepak ji, that question is that how we're going to pass the journal entries. I think when we're going to pass the journal entries, we would get the answer to that.
Correct.
As you were narrating, I was trying to work it out, but दिमाग मान रहा है, दिल नहीं मान रहा है, ऐसा नहीं हो सकता.
So, just to add one thing, just to add one thing, and then the same line, if you see clause number 14, it says the method of valuation of closing stock, and in the clause B, this is in case of deviation from method of valuation prescribed under 145A. So, in case of deviation, they are asking about not whether is there a change in method. No, the question is absolutely different. They are saying that the deviation from 145A, it means there is some deviation that needs to be reported, if any. So of course, I think Deepak ji and Pankaj ji both are right to some extent, giving their views, and of course this need to be tested with a practical example, then whether it's actually a tax neutral or not.
And Sachin ji, if deviation is not there, then what is the requirement of this particular section or
yes,
clause in false
agree with that. That's why I highlighted. That's why I highlighted this clause, sir.
Yeah, nice observation that you are picking that particular aspect. Why it is required? That's the main question we should answer.
So next question over to you, Sachin ji. Very nice deliberation for this clause for 145. Thank you so much, Pankaj ji, and all the
Thank
best.
you.
So clause 15, this says that date of acquisition and the value of transactions. So it states these. So this is regarding, giving the following particulars of capital asset converted into stock in trade. So it may so happen that the asset acquired before 2001, in such a case, the firm is silent to give the value as on 1st April 2004. Due to this, the value of capital gain may be reported wrongly. Please clarify. Sachin, for you.
Okay. So this is in respect of clause number 15, which says give the following particulars of capital asset converted into stock in trade. And we all know that if the capital asset is converted into stock in trade, the taxability will arise in the year of actual sale, the capital gain and the business income. Now the information they are asking, that the description of particular of asset, and that you can give date of acquisition. So assuming the date of acquisition is prior to 1/4/2001, then you have to mention that date, because it's not saying anything in respect of 1/4/2001, and the cost of acquisition. So generally, while we are calculating the capital gain on sale of immovable property, assuming I'm converting an immovable property to the closing stock or stock in trade, then the situation would be we need to value that property to at 1st April 2001. However, the clause does not asking about anything. It says the date of acquisition. The date of acquisition should be the actual date of acquisition, not the 1/4/2001, and the value and the cost of acquisition. So what would be the cost of acquisition? Of course, the actual cost of acquisition, or whether if it is gifted, then what will be the cost of acquisition? Then it says that we have already said that in case of gifted asset, the cost of acquisition should be the original buyer. Then in that case, assuming the property value increases subsequently, and on 1st April 2001, the value is different. Of course, it would be different. Then in that case, how to report it? Because of course, they will calculate the capital gain on basis of information you will give there. And your computation of income will not match with the detail you are giving here. Now, the second question is, as you have converted this and sold the same asset during the same year, then how to report it? So converted the capital asset in the year 2022-23 and sold that asset in the same year as a stock in trade, then how to report it? So there's few information which actually required to trace the transaction, the taxability of the transaction, or the actual quantum of the tax. That is missing. They're asking for the information which actually serve no purpose to my mind.
Any addition to it?
Yeah, I agree with Sachin sir in that particular aspect, and I would like to add one particular thing, that when we talk about the fair market value as on 1st of April 2001, the section 55 simply says that the assessee can go for the actual cost of acquisition or fair market value as on 1/4/2001 as the option of the assessee. And now the section 55 defines the cost of acquisition itself. So in my mind, that when the assessee opts for 1st of April 2001 value, that becomes nothing but cost of acquisition itself. So in my view, that what we are following, even that we report date of acquisition as the actual date maybe of 1995 or maybe of 1980, but in the part of cost of acquisition, we report that fair market value as on 1st of April 2001. And second thing, as professional, if we talk about the Form 3CD is the responsibility of the assessee, he should fill that particular cost of acquisition equal to fair market value. And as an auditor, we should give that particular observation that assessee has filled fair market value in that particular column, and all the actual cost is this. So I think that will be the win-win situation for both the assessee and as an independent professionals we talk about.
Agreed.
Thank you very much. So we go to the next question. So this is for Deepak ji. Very interesting question. Rate of depreciation on mobile phones. So please elaborate the interplay of claiming different rates. Now mobile phones can also be used as laptops and as computers, and they are just everything to us. So Deepak ji, to you.
Sorry. So if I may add to this discussion, with your permission, of course, what would be the depreciation rate on, say, printers, scanners also?
40%.
Printers, scanners, मैडम ने डिक्लेयर कर दिया 40%, वेरी राइटली सो. आपके स्टेट में दिल्ली हाई कोर्ट इज in the case of Yamuna Powers Limited, way back in 2008, if I recall correctly, has concluded that printers don't have any standalone usage. Printers by itself as an independent equipment has no usage. It necessarily has to be connected to a computer to function. So it is a computer part of computer system. It's a computer peripheral, right? So, and as we know, the depreciation rate, the general depreciation rate which is available for all plant and equipment is 15%, but for computers including computer software, this is the wordings used over there. So computers including computer software, the rate of depreciation given to us is 40%. And Delhi High Court in Yamuna Power's case said that not just computers, even computer peripherals. Computer peripherals is the word that was coined by the judiciary to say all computer peripherals will also enjoy a higher depreciation rate of 60% as it was then prevailing. So based on that Delhi High Court judgment, there was a subsequent other High Court judgments, several tribunal level judgments which went on to add to this list of printers. They went on to add scanners, UPS, your network equipments like switches and routers. All of these have been held to be part of computer system, computer peripherals eligible for a depreciation at the rate of 40%. Now coming to the question on depreciation rate available for mobile phones. There was a 2011 judgment of Kerala High Court in the case of Federal Bank Limited. 1.5 page judgment, reasoning nahi hai, there's no logic given, but then there's a conclusion that mobile phones will be eligible for a depreciation of 15% and not 60%. 2011 का judgment है, with all humility, शायद जज के पास then was not did not have access to smartphones, button phone रहा होगा, तो 15% एक बार के लिए मान लेते हैं. फिर 2019 में बॉम्बे हाई कोर्ट का एक बॉम्बे ट्रिब्यूनल का एक बहुत अच्छा जजमेंट आया इन द केस ऑफ हिंदुस्तान फील्ड सर्विसेज प्राइवेट लिमिटेड, वेयर इन a beautiful analysis of the term computer was done by Bombay Tribunal. So the definition of Bombay Tribunal under IT Act. IT Act here is not Income Tax Act, Information Technology Act. Income Tax Act, there is no definition of the term computer. Information Technology Act defines computer very broadly, roughly speaking. It defines computer to mean any electronic equipment which has input, process, and output services. So Bombay Tribunal made a finding that yes, a mobile phone, a smartphone of today has input. There is an audio input, there is a touch input. Mobile phone of course has a processor inbuilt into it, and there is also output by way of a display screen, and there is also an audio output. So it has all the essential ingredients of a computer system, and therefore it is a computer. It is eligible for a higher rate of depreciation at the rate of 40%. This judgment stayed for 2 years until 2021, wherein Amritsar Tribunal, in another case of Kohinoor India Private Limited, gave an interesting twist to this entire issue. Now, before Amritsar Tribunal, the question was specifically with regards to iPhones and iPads. The costliest in the segment that you will find, the smartest, possibly one could argue, among the smartphones that we have. Specifically on the issue of iPhones and iPad, the matter went up to Amritsar Tribunal as to what should be the rate of depreciation with regards to iPhones. Now, here Amritsar Tribunal went into a test of predominant usage or predominant object of the mobile phone. So the tribunal there observed mobile phone का primary purpose क्या है? Now, why do we primarily buy a mobile phone for? Making calls. What other functions do we use? Sending emails, receiving emails, FaceTime, iTunes. So all of these, the Bombay Tribunal concluded are communication purposes. So your iPhone is not a computer. It may have some ingredients of a computer system. It may have processing capacity. It may have an input and output. But the predominant purpose, the predominant usage of a phone is communication. So it is a communication device and not a computer equipment, and therefore it should be eligible for a low rate of depreciation of 15%. Assisi before the tribunal argued, sir, your honors, printers को आप 40% दे रहे, iPhone को आप 15% दे रहे, ये तो. But then again, the tribunal had an interesting observation to make. See, printers we allow 40% because it was a part of the computer system. It cannot be put to use independently. iPhone can also be connected to the computer system, but it is capable of a independent usage, and which is its predominant usage, and therefore it does not form part of a computer system. It cannot be called a computer peripheral. Therefore, the rate of depreciation that is allowable to a iPhone or iPad is 15% and not 40% is what Amritsar Tribunal tells us.
So, Deepakji, if I can ask one more question, what about Kindle or e-books, which we are talking about?
E-books are books, and books are eligible for 40%.
So that means Kindle, if we are using for our reading purposes, then we can take 40%.
we will take 40% and then we'll fight a case and have a landmark judgment in your name.
Thank you so much. So next question.
So just to add, Deepakji, so if you give the command of printing through your mobile phone, then whether the printer will get 15% or 40%, just lighter note.
वो प्रिंटर वाला केस यमुना पावर का 2008 में था, तब वाईफाई प्रिंटर्स का जमाना नहीं था, तो प्रिंटर्स then used to be USB printers connected to the computer system. But that's an interesting question. So I would still argue that it is capable of being connected to the computer, and predominantly it is connected to the computer in normal office environments. कंप्यूटर से ही प्रिंट देते हैं या लैपटॉप से प्रिंट देते हैं, तो आई विल स्टिल क्लेम इट एज पार्ट ऑफ द कंप्यूटर सिस्टम. Although it has a functionality to work from a mobile phone also, but its predominant usage is in normal scenario is being printed through a computer system.
I think Sachin ji इसको भी BAP section plan में cover करना चाहिए. You should give the recommendation.
But Deepakji, we don't require a computer or a server to be open to use a Wi-Fi mobile. Say if I give a printer direct print command, so it will take it directly. I don't need any laptop or anything for that. Even the server is not required to be open.
So that's an argument that should come from the department. To counter that argument, my counter would be, my printer is a smart printer capable of taking a print command from the mobile phone also, but the predominant usage of my printer is taking prints from the computer system.
So thank you very much. A very interesting, discussion and a new discussion. In fact, we never heard of printer and mobile, having discussions on 40 and 50% depreciation. So yesterday when we were having a discussion on it among us ourselves, I was, really happy to know it that, my Kindle will get a 40% discount, 40% depreciation. So next question to Sachinji. So where any land or building or both, this is related to clause 70. So where any land or building or both is transferred during the previous year for a consideration less than value adopted or assessable by any authority of a state government referred to in section 43 CA or 50 C. So please furnish, assuming land and building or both transferred during the previous year at a price lower than the stamp duty value, and on the date of agreement, the buyer paid some amount of money through banking channel, and on the date of agreement, the fair market value and the stamp duty value was same. How to report the same in the clause? You are on mute. Sachinji, you are on mute.
Thank you, ma'am. So this is very interesting clause because again, I'd like to highlight some of the issues in this clause. So this clause is very interestingly says where any land or building or both transferred during the previous year, and if it is less than the stamp duty value, then it is to be reported here. Either it's section 43 C or section 50 C, and they ask for the details. That the detail of the property, number one. Number two, consideration received or accrued. So assuming you are receiving or it is accruing, of course, less than the stamp duty value, and the value adopted by the value adopted or assessable value. And the last clause says whether the provision of section 43 CA1 and 56(2)(10) proviso, the fourth proviso is covered or not. So fourth proviso is giving the bracket of 20%, and similarly 43 CA1 gives a 10% bracket or 20% for a certain period. But the issue is, assuming 5 years back, I entered into a transaction of purchasing a land or building, and at that time the stamp duty, we agreed at the stamp duty value. Now I am making the payment. And of course I have made the payment accordingly considering today's value, and the registration took place today. So do I need to mention that the agreement was taken place 5 years back, and the stamp duty value we have taken what was actually existing on 5 years back? So these details are not actually, they are asking nothing about this. So to my mind, this form should also cover such type of information, so that the SSC can give the particular description about the transaction. This is a very quiet transaction where it says that consideration received and value adopted. So consideration received assuming X and value adopted Y. So what is the difference between X and Y? That is to be. But why I have taken the value adopted? Why? Because the agreement was taken place 5 years back. and we have made some payment, because the law also says that there was proviso clause which says if you have made some payment, although it is not quantified the how much payment can be said as some payment. Secondly, through the banking channel on the date of such agreement, what if I have made that payment after the date of agreement or before the date of agreement, or what if I have not made the payment at that time, but the agreement was registered with the stamp by paying the stamp duty. So there are so many permutation combination can take place. So it's not a blanket transaction by reporting A plus B equal to C. So of course, since because the proviso or the section is not asking for this part, so to my mind, the question they're asking in Form 3CD, this should be more elaborated to consider those aspects also.
Any other thoughts on it? So, next question. So this is for Pankaj. There is a confusion regarding applicability of tax audit where profit margin is less than 6 or 8%, but turnover is up to 2 CR. Can you please elaborate the issue and legal come practical answer to this?
Okay, good, Smita. Friends, if there is a confusion in this particular aspect, whether the profit margin is less than 6% or 8%, I'm assuming even after the margin is less than 6%, the total income is more than 2.5 lakh. I'm not going to that particular aspect, whether the income exceeds threshold limit or not. Friends, if we are doing audit in this particular scenario, then I think we are believing on the provisions which were existing even before Finance Act 2016 amendment. By Finance Act 2016, it has been made very clear that by virtue of margin less than or 6%, audit is required only in case when conditions of section 44 AD subsection 4 are fulfilled. Now, what is subsection 44 AD subsection 4? It simply says that if you have opted for section 44 AD in the prior year, and if you are opting out from section 44 AD next 5 years, like for example, it is altogether my new business in Y1, that is year 1 I'm denominating, and I opted for 44 AD. Now in Y2 to Y6, if I'm opting out from 44 AD, although I'm eligible, then only that audit requirement comes into the picture. Like for example, I followed 44 AD for Y1, Y2, Y3, Y4. Now in Y5, although my turnover is up to rupees 2 CR, but actual margin is less than 6%, and I do not want to pay tax on 6%. Now, in that case, I'm opting out from section 44 AD. In that case, section 44 AD4 says that you have to go for tax audit for that particular year and even for next 5 years. Now, coming to the other way around, it's altogether my new business. It's Y1. My turnover is up to 2 CR. Margin is less than 6%. I'm maintaining books of accounts in terms of section 44 AA. Whether I'm supposed to go for the tax audit? No, friends. If turnover is up to 1 CR, no audit is required. If turnover is between 1 CR to 2 CR, then we need to check the cash involvement. If it is more than 5%, tax audit is required. Otherwise, it is not required. Or even if you are following 44 AD for more than 6 years consecutively, now this particular is 7th year or 8th year or 9th year or 10th year, as the case may be, and assessed do not want to follow 44 AD, friends, tax audit is not required at all. Why am I addressing this particular situation? Friends, the thing is that if audit is not required, but still if we are doing the audit as professionals, friends, in my personal view, we are going for the professional misconduct. It is our responsibility to educate the assessee that audit is not required. Still, if the assessee, you can say the assessee insists that I have to go for the audit of the books of accounts. Friends, in that case, we cannot certify Form 3CD at all. We can go for the audit of the books of accounts, but not Form 3CD at all. So it may lead to the professional misconduct. It may also lead to the aspect that we are helping the assessee in extending the due date of ITR by giving Form 3CD, although it is not required. So as professional, we should take care of that particular aspect. So that's my view in this particular aspect. Any other view, Sachin sir, Deepak sir, most welcome. And maybe the Murmuji of our this particular webinar today, that is Smita ma'am.
So, Pankaj, I have one question in this.
Yeah.
So, when we are opting for 44 AD4, as you are saying, so we are saying that in case our threshold, if we are opting it once in say 1 year, year 1 say, and our threshold, our turnover is less than 2 CR, then in the next year we opt out. Then over the years, we are supposed to do the tax audit for next 5 plus 1, 6 years.
Yeah,
Correct?
yeah.
So even in that case, if our threshold is less than 1 CR over those years,
Okay.
then in that case, we will continue to do the tax audit.
In my view, Smita, that if we opt out, for example, in Y2, then
Yeah.
Y2 to Y2, 3, 4, 5, 6, 7, Y7, we
Yeah.
have to go for tax audit for 6 years,
Irrespective of
except
the
in one
threshold.
case, except in one case. And that the single case is that if income is up to 2.5 lakh,
Yeah.
then audit is not required.
Yeah.
If it is more than 2.5 lakh, now business turnover is whether 10 lakh rupees, or it is 90 lakh, or it is 1.5 CR, or it is 3 CR, whether cash involvement is within 5% or more than 5% does not make any difference.
Correct.
In any case, we have to go for audit for next 6 years without any doubt. That is my interpretation of section 44 AD.
Correct. So that means in case there is a loss, or if we have never opted for 44AD in case 1, then we don't have to do anything. And if we are below the threshold, that means even if we are in loss position, but then we are saying if we are in loss position, then also we need not go in audit even if we have opted out in year 2.
Yeah,
If
then
we are
audit
in
is not
loss
required
also.
because 44 AD is so, yeah. You're
Because
right, you're right.
Lower than the threshold.
Yeah, lower than the threshold.
Right. So thank you so much. So Deepakji, this is for you that I am a partner in a partnership firm receiving remuneration and interest on partners' capital. I have no other business income. Can I opt for 44D? I think we have discussed this, but if you can elaborate more on it.
We partially discussed this aspect.
Yes.
I can simplify this question with the help of an illustration. Let's say I'm a partner in a partnership firm and deriving partners' remuneration and interest on partners' capital to the tune of, let's say, 45 lakhs. Now, this 45 lakh, can I offer it to tax under 44AD is the question here. And the very clear answer given to us by Madras High Court in the case of Anand Kumar's case is no. The rationale being 44AD is available to an eligible SEC carrying on eligible business. Now, in this setup of a partner and a partnership firm, the business is carried on by the partnership firm and not the partner in his individual capacity. Yes, the remuneration and the interest on partner's capital is getting taxed under the head PGBP because of a specific provision under Section 28, but that does not make him a SEC who's carrying on any business activity. Moreover, as was rightly observed by the High Court, for 44AD to work, there should be some turnover on which we apply the presumptive rates of 6% or 8%. Now, it would be absurd to say the salary that I'm getting from my partnership firm or the interest that I'm getting on the partner's capital is turnover. So, therefore, the mechanism of 44AD would also not work, and therefore, 44AD would not be an option available in this scenario. And this is the case which was followed by Bombay High Court in the case of Perizad Zorabai Irani, which we just discussed a couple of minutes ago, wherein Bombay High Court concurred with the view of Madras High Court and gave the exact same set of conclusion.
I have one more question in this, Deepakji, that, for example, there is a doctor who is also a partner in the nursing home or clinic, whatever. He is getting remuneration also, and he is being paid professional receipts also. So are we saying that those professional receipts, if that crosses the threshold of 50 lakh in being a specified profession, will that also be excluded, or will that also be because he's also a partner in that nursing home, or maybe, whatever the nomenclature is?
Rightly or wrongly, the courts have viewed on this aspect business is different from profession. Now, there is this Kolkata tribunal judgment in the case of Sagar Datta. Mr. Sagar Datta, being a partner, chartered accountant himself, partner in PwC, derived remuneration in excess of 10 lakh, which used to be the limit for tax audit for professionals. And he did not subject himself to tax audit. He was served the order under 271B, and he went on to lose the case before before Kolkata ITAT. The observation there was that in case of a professional, Sagar Datta, being a chartered accountant holding a certificate of practice, is carrying on profession not individually but collectively as a firm. See, firm as such cannot be a professional. The professional activity is that's the you agree or not, that's the conclusion of the tribunal. It is not the firm which is carrying on the professional activity, it is the firm through its partners. So it is a partner who is exercising or practicing the chartered accountancy profession through the firm, and therefore the receipts that he gets from the CA firm are nothing but professional receipts, and that are subject to tax audit if they breach the limit of 50 lakh that we presently have under 44AB clause B.
So Deepakji, here if I can add to this is that I understand that in chartered accountants case particularly, the firm and COP and plus our code of conduct doesn't permit us to have professional receipts, sir. But in case of the profession of medical profession, I'm talking of,
Same
so
logic would apply to also.
their code of ethics, yeah,
Even they have a
their
similar requirement of getting
yeah,
a
professional
license.
receipts also. Yeah. So
Yeah.
they can receive professional receipts also in addition to being a partner of that nursing home or whatever, sir. So that is the reason my specific question is directed to only doctor and not CA, because I know we are out of it. But can doctor having professional receipts because he gets X amount on the surgery he has operated or whatever he has done in the in the guise of being a doctor, in addition to the profit whatever he's getting as a partner of that nursing home or hospital. So can we say that those professional receipts are liable to 44AB and his remuneration, or the profit obviously will be excluded from this?
If you were to apply the ratio of Sagar Datta's case, the remuneration that he is drawing from the partnership firm are also professional receipts.
I agree, but that was the reason I specifically said this is the case of doctor. So
No, this, in my view, should apply equally to any profession, be it accountancy or architecture or medical profession. The ratio, as is laid down by Kolkata Tribunal, should apply to even these professions.
okay. So any other view if any panelist has on this? Pankaj or Sachin ji? Okay, so we move to the next one. This is for, we are going to, yeah, so this is for Pankaj ji. In deposit of employee contribution to PF, etc., there is a delay of 10 to 15 days, which is very normal. After amendment by Finance Act 2021 and Honorable Supreme Court judgment, it is very clear that same needs to be deposited by due date of relevant act and not section 43B. So is there any solution for such short delay? And if yes, then how to report the same so that additions under section 143 subsection 1 are not there?
Okay. Friends, first of all, we all know that particular dispute which was there since 2021, which was settled by the amendment made by Finance Act 2021. And in very clear manner, it was laid that in any case, section 43B will not be applicable for the deposit of employees' contribution to PF. That means that need to be deposited by, in any case, 15th of the next month. Now, the question arises that 15th of next month is to be interpreted from which particular month? Like, just for a simple example, I'm taking that for the salary of May month, May 2022, the salary is being paid to the employees on 7th of June 2022. And out of that salary, as an employee's contribution is deducted by the employer. Now, the question arises whether this PF contribution is need to be deposited by 15th of June, considering that the salary is in relation to May 2022, or it is to be deposited by 15th of July, considering the aspect that employee's salary is paid on 7th of June, from which this contribution is deducted. In my view, friends, even if I go by the legal precedents in this particular aspect, that PF contribution liability triggers on the date when it is deducted from the salary of the employee, or we can say when the salary is actually paid to the employee. Now, in this particular case, in our example, the salary is paid on 7th of June. The liability to pay triggers on 7th of June and not 31st of May. Whether we are maintaining books on accrual basis of accounting, that does not make any difference for that particular aspect. In my example, the due date shall be 15th of July and not 15th of June. And this is supported by many legal precedents. If we talk about, there are two precedents which I have in my idea, that is Fluid Area India Limited. That is a 1997 judgment of the Mumbai Tribunal. And then Madras Radiators and Pressing Limited versus DCIT, 1996 judgment. And there is one unreported judgment also of Calcutta Tribunal in the case of Kanoi Paper and Industries Limited, which was filed in 1996 and decision was rendered in 2001. And in all the judgments, the clear-cut view was followed that the liability will be counted or month will be counted on the basis of the date of payment of that particular salary to the employee and not on the basis of the accrual basis. Now, coming to that particular aspect, now how it is to be reported in Form 3CD. Friends, if you recall the situations around 2 years before, that many of the assessees had notices or additions under section 143(1) in respect of late deposit of employees' contribution. At that time, the maximum assessees were following the view that due date of ITR is applicable, following the various judgments, including AMIL Limited, Delhi High Court 2009 judgment and various other judgments. Now, what was happening when the assessee was filing Form 3CD, or we were certifying Form 3CD? We were reporting as May month salary, due date is 15th of June 2022, and deposited on like September 2022 or October 2022 or maybe July 2023. Now, in the Form 3CD, we are punching the due date as 15th of June or maybe 15th of July, relying upon these particular judgments which I have discussed with you. Now, in Form 3CD, we are taking a view that due date is 15th of June 2022. But while filing the return of income, the assessee is relying upon those particular High Court judgments and saying that that PF contribution is deposited on or before due date of ITR. Hence, it should be allowed, and hence no disallowance is being made in Form ITR Schedule OI at all. Now, that is the clear-cut difference in opinion of the assessee itself at two stages: Form 3CD versus ITR. I think in Form 3CD, in that particular scenario, the due date should have been filled as 31st of October 2023. I'm relating that particular years, coming to that same example today even. Now, friends, if we go by the Form 3CD utility, the due date does not populate automatically. It has to be punched upon. And if we are relying upon these particular judgments as assessive, and then due date should be punched as 15th of July and not 15th of June. And accordingly, ITR should be filed. There should not be no contradiction between Form 3CD and ITR. If there is a contradiction in the view, obviously the adjustments will be there under section 143(1). So that particular scenario should have been taken care at that time of filing of tax audit reports for assessment years prior to 2021, and that practice should be followed as on date even. So that is my particular view in this particular employee's contribution to PF.
Anything anyone would like to add? So thank you very much, Pankaj, because this would be helpful to a lot of people hearing it, because generally what we were doing were that we were taking the date on which we were doing the provision and not on the date of payment. So this will really be helpful to everyone. Thank you. So we take the next. This is So this is for Sachinji. This is on clause number 21A. So our interest paid for delayed remittance of GST, professional tax, provident fund, etc., to be reported as penalties paid under clause 21A. Is it interest for delayed remittance? Is interest for delayed remittance of TDS allowed as deductions? Is GST late filing TDS, late filing fees, penalties? Should it be reported under clause 21?
So 21A.
This is for Deepak ji, I think.
For Deepak ji?
Yeah.
Okay.
So the question here pertains to section 37, which calls for disallowance of certain expenditure. To be precise, expenditure that has been incurred for the purpose which is an offense or which is prohibited under law. In simple words, in short, if the expenditure is penal in nature, it has to be disallowed. Otherwise, it has to be allowed as an expenditure, as a deduction. The question boils down to whether the interest that is paid for delayed remittance of all these taxes, that is GST, PT, PF, ESI, and all of these, are these penal in nature? Now, we have had a catena of judgments on these, starting from our sales tax era, wherein the courts have gone into the provisions of each of these indirect tax statutes, and they have concluded that none of these provisions are penal in nature. The interest that is paid is pure time compensation of money. There was a sum of money that I owe the government today. I am paying it with a delay of 10 days, 20 days, or a month, and I'm paying interest for that delay. So it's pure time compensation of money, and it is not penal in nature, and therefore no disallowance is called for under 37(1). The landmark, the most predominant judgment on this issue being that of Supreme Court in the case of Lakshman Das Mathur. I think the same ratio can also be extended to the interest that we are currently paying under Section 50 of GST Act. Again, it has similar wordings to that we had under the earlier indirect taxes, and that is also not penal in nature and not to be disallowed. Now, coming to the next portion of it, Interest for delayed remittance of TDS. The interest now that is paid under 201(1)(a) is also not penal in nature, as is being upheld by Karnataka High Court in the case of Orient Insurance. There is a Madras High Court categorical finding that this interest is also not penal in nature and therefore is mandatory. It was rendered in that context, but then we can draw the ratio out to say that it is not penal in nature and therefore it has to be allowed as deduction. But then there was another interesting angle given, interesting perspective given to this issue by Calcutta High Court and Madras High Court way back in 1999 in the case of Chennai Properties Limited. Now, again, rightly or wrongly, the High Court went on to conclude that interest always partakes the nature of the principal. The characteristics and the color of principal would be the characteristics and color of the interest as well. Now, in this case, interest on TDS. Now, what is the principal? Principal is TDS. TDS is what? TDS is nothing but income tax. Now, income tax is a specific item of disallowance under 48(2). Under 48(2), I cannot be claiming deduction for any income taxes that I pay. Now, the principal not being allowable as deduction, the interest can also not be allowed as deduction, was the conclusion drawn by Madras High Court in way back in 1999. Now, this continued for some years, and then in between 2005, we had a Kolkata Tribunal judgment ordered in the case of ABN Amro Bank's case, wherein strangely, humbly put, the tribunal did not even get into the controversy of 48(2) disallowance. Is that वहाँ तक जाने का जरूरत ही नहीं? Is it allowable under 37? Is it incurred for the purpose of business? No, it is not a business expenditure. It is a personal expenditure, and therefore it has to be disallowed. Again, humbly put, I don't subscribe to the view of Kolkata Tribunal. Company having personal expenditure is not heard of. This is a definite expenditure incurred in the course of the business, and on that ground, at least, thankfully, other courts have also not looked into it. Other tribunals or other subsequent judgments have never touched on this, have never adopted this ratio in their judgments. And then in 2008, 2009, we had a bunch of Kolkata tribunal judgments in the case of Narayani Ispat, Rungta Mines, wherein the Kolkata tribunal dwelt a little more deeper into this issue to analyze and conclude ki what is disallowable under 48(2). The 48(2) talks of disallowance of taxes on profits and gains of the SSE. Now, when I talk of interest on TDS, it is whose interest? It is whose tax? Is it the tax of the deductor or is it the tax of the deductee? It is the tax of the deductee, and therefore it does not fit into a 48(2) disallowance. It was widely appreciated, adopted by several other tribunals. Bombay Tribunal, Delhi Tribunal have all consistently followed Kolkata Tribunal on this ground to say, no, it is not a tax. It is not a tax on the deductor's income. It is a tax on the deductee's income, and therefore interest paid for delayed remittance of such tax cannot be disallowed under 48(2). Unfortunately, in Bangalore ITAT recently in case of Expact Engineering chose to follow Calcutta High Court on the grounds of judicial discipline. The decision coming from a higher judicial authority, and concluded that it has to be disallowed for the purpose of income computation. So we have a strange scenario wherein Bangalore Tribunal is following Calcutta High Court. Kolkata Tribunal is not following Kolkata High Court. So if you're in the state of Karnataka coming within the jurisdiction of Bangalore ITAT, the present position is it has to be disallowed. But all other tribunals across the country have followed the Kolkata Tribunal in the case of Rungta Mines to say that it is not an item of disallowance, it has to be allowed as expenditure. The last bit, TDS late filing fee and GST late filing fee. TDS late filing fee, there's a late filing fee under 234E at the rate of 200 rupees per day for the delay in filing. Now, when 234E was introduced sometime in 2013, if I remember correctly, it was challenged at high courts across the country on the ground that this is penalty in the guise of fee. And because it does not provide for any opportunity of being heard, it is unconstitutional and it has to be struck down. Across the high court, across the country, all high courts took a consistent stand that no, a fee is distinct from a penalty. Fee, where there is a quid pro quo. Now, I charge a professional fee from my client. In return, I give some service. So likewise, when the department charges TDS late filing fee under 234E, it's giving a service. What is the service? The service is a privilege that it gives you to file a belated return. 31st October is the due date for you to file the return of income, but the TDS statement, but then you are allowed to file it even on 1st of November, on 1st of December. So that's a privilege. So that's a privilege fee that is being charged under 234E. Moreover, by the reason of the deductor filing late, belated TDS statement, there's a whole lot of reconciliation issue which is created, for which entire body, CPC Ghaziabad, traces is sitting with the department, for which huge costs are being incurred. The deductee would claim it in his return of income, but he would not be allowed the deduction, resulting in demands, rectification, all this exercise resulting in a justified levy of 234E fee. So that distinction being given to us, a fee is not a penalty, and therefore even that does not require any disallowance under 37(1). The same ratio, I am sure, can also be extended to GST late filing fee also. Again, that's not penal in nature. It's a privilege fee that we are paying to the government for filing belated returns, and therefore that also should not be disallowed under 37(1).
Thank you so much, Deepakji, and I will just jump the queue and will take this clause 44 because it is of interest to everyone. So, Pankajji, over to you. In clause 44, clause 44 GST details whether any common mistakes have been noticed and which we should take care in the current assignments.
Smita, in my personal belief, there are many mistakes, but I would like to highlight one at this particular stage. The thing is that if we go by the guidance note or the opinions of the various authors, they talk about the provision for bad and doubtful debts, and they're not talking about the other provisions. Like, for example, provision for warranties. Like, again, provision for warranty is a non-cash charge. So when it is a non-cash charge, according to the guidance note, even in my opinion, that is to be treated as part of column number 2 of the clause 44, but not of the part of column number 3 to 7. But the question arises, if in the next year that provision for warranties is being used for the purpose of the warranty claims of the various customers, it is quite possible I have provided some services, or I have provided that repair of the particular things, or maybe some parts of that particular product I'm manufacturing, which is debited to the provision for warranties account and not to the P&L account in the second year. Whether this is required to be reported in that particular second year, and it is quite possible it is second year as on date. Friends, in my opinion, that is required to be reported as part of column number 2, as well as part of column number 3 to 7, depending upon the warranties expenditure which I have incurred is from which particular party. So that is the common mistake which I have identified, that we are not looking into the expenditures which are debited to the particular ledger accounts, which are forming part of balance sheet and which are not forming part of P&L account. So that we should take care while reporting this particular clause 44 details.
Thank you so much. And Sachinji, for you, please discuss the applicability of this clause, even if it's a non-registered entity.
So, while talking about the registration, clause 44 itself says that it will be applicable whether or not you are registered. So I think, assuming you're a lawyer and you're not required to get registered under GST, even in that case also under tax audit is applicable in your case, then even in that case also clause 44 is required to be filled up, and all the details which is required in clause 1 to 7, that needs to be clearly filled up.
I'll go with the last question as we are just running out of time. So this is regarding to 43B liability. So this is for you, Sachinji, again. So liability under section 43B pre-existed on the first day of the previous year, and the clause says paid during the year and not paid during the year is to be reported, but there may be a situation where it is not paid but reversed during the year. In such cases, how to report in this clause?
Yes, so again, I would like to highlight the issues which is in the form. As I earlier mentioned, the form doesn't ask for many other information, but actually the assessor should report while filing this form, because if you did not report those information, the particulars what you are furnishing in the report may not give you the clear picture, or to the assessing officer it will not give the right picture. And in the same context, if you read section clause 26A, it says in respect of any sum referred to in clause A, B, C, D, E, F, G to the extent of 43B, and if it is pre-existed on the beginning of the year, and then there are two clauses: paid during the previous year and not paid during the previous year. So assuming you have reversed the transaction during the previous year, then in which category you will fall, whether it's a paid during the year or not paid during the year. Of course, you're not paid, you have reversed it. So how to report those that situation? And there are many other situations also. So I just highlight one situation, and to my mind, there's this form should contain other requirement also to so that SSE can fill up the complete detail of the transaction.
And Deepak ji, this is for you. Do disallowances like 43B attract in case of an assessee whose income is computed under section 44AD?
44AD, as we all understand, is inclusive of all allowances. Now, let me explain this with an illustration. Let's say I am an SSE whose turnover is 1 crore and I am willing to offer income at the rate of 8%. So this 8 lakh we all understand is inclusive of all allowances. I don't get any further deduction under the head PGBP with regards to this 8 lakh of income that is computed under 44AD. The question here is this 8 lakh also inclusive of all disallowances? To this 1 crore and 8 lakh data that we have, let me give you additional information to say I have a GST unpaid liability of 10 lakh which I have not paid till the date of filing my return of income. So what should be my taxable income that I report in the return of income? Is it 18 lakhs or 8 lakh is the question. Unfortunately, the Panji tribunal in the case of Good Luck Kinetic has gone on to answer this question in favor of revenue. So Panji terminal went into a read of 44AD and 43B. Now 44AD starts with a non-obstant clause. It reads, notwithstanding anything contrary contained in section 28 to 43C of the Income Tax Act, the computation will be so and so. 43B also starts with a non-obstant clause reading, notwithstanding contrary to anything contained in any other provisions of this Act. So both these provisions having non-obstant clauses seem to be in a loggerhead with each other. Now the resolution provided by the Panji tribunal was, look at 44AD. 44AD is overriding 28 to 43C. 43B is overriding all of the provisions of that. So the overriding powers of 43B are of far more wider amplitude than the provisions of 44AD, and therefore 43B has to be applied over 44AD computation, and therefore in the example that we discussed, the taxable income should be 8 lakh plus 43B disallowance of 10 lakh and 18 lakh in the view of Panji tribunal, which I humbly would want to disagree with. There could be two more plausible arguments which could have been made but were not made before the Panji tribunal. Number one being, look at 44AD. 44AD is overriding 28 to 43C specifically. 43B is overriding all of the provisions of the Act generally. Now, accepted view of interpretation is that the specific provision of the law overrides the general provision of the law. 44AD being a specific override vis-a-vis 43B being a general override, it is 44AD which should override 43B and not the other way around. That's argument number one which should have been put in place. Argument number two, again not argued before the tribunal, there was when 44AD overrides 28 to 43C, it overrides a very important section, section 29. Section 29 is the entry gate to the machinery provisions of PGBP. The 29 reads, income chargeable to tax under section 28 will be computed in accordance with provisions of section 30 to 43D. So once, and then 29 does not have any overriding non-obstant clauses. So once 29 is overridden by 44AD, there is no scope for applying 43B provisions, and therefore, yet again, 43B should not have been invoked for 44AD computation. Recently, there's been one Raipur tribunal judgment on the same matter. There, another very interesting perspective given to this issue by Raipur tribunal was, now look at the computation of the SSE. Look at this, there the issue was with regards to disallowability of interest expenditure. So there was some unpaid interest with the assessing officer in the assessment order had disallowed under 43B. Now, Raipur tribunal went on to hold that look at his computation. His computation is plain and simple. It is 8% of 1 crore. 8 lakh is what he is offering to tax. Where in this computation is he claiming any deduction with regards to interest expenditure? Now, any disallowance should be preceded by a claim for allowance. Nowhere in the computation the assessee is making a claim for allowance of interest expenditure, and therefore there's no question of any disallowance. And yet, for this reasoning also, in my view, 43B should not be 43B, or for that matter any other disallowance provision should not be invoked when applying 44AD provisions.
Thank you so much, Deepak ji. With the permission of Chairman sir, I can take the queries. If I can add the session for 5 minutes.
Yes, ma'am. Yes, ma'am. I feel that you have done a very wonderful job here. And there are a few queries which Ashok sir has.
I will just take the queries.
Yes, please, please.
So our assessees engage in PMS service. So we were to invest on the behalf of our client, and profit is profit is belonging
Belonging to the investor.
belonging to the said investee. So in that case, even thought investment held in our name, how will we incorporate in our books of accounts?
If my understanding of the question is correct, so there is some investment activity being carried on behalf of the client, but the question does not seem to be a PMS kind of a setup, because
Correct.
in the question it says that the investment is held in my account, unlike in a PMS setup wherein the investment activities are carried on by the manager, but in the name of the investor. So this being the case, the investment having been carried out in my account, it is my income, it is my loss. I'm a little lost on the question here.
Okay. I think the question is not very clear, so if they can clarify and send us again. If the tax audit report is to be revised mandatory, is the if there is payment subsequently under section 4043B of the Act before filing ITR, kindly advise. I think we have already taken up this query that
Ma'am, one suggestion here. If we are not able to take the questions as due to time constraint here, what we can do, we can take the questions and we can reply through the mail or through the WhatsApp group that is there here. And we can reply the who is the attendee, and we can send them the reply through mail.
But there are hardly 3 questions, and I think out of 2 we have already covered here. So we go with the rest of the question. This question we have already, tax audit revision, we have had a great discussion on it already. And I think we, as Pankaj said that, choice of getting it mandatory revised is only once it is there in the engagement letter. Although ICA guidance would have.
I think in this question, Supreme wants to know that whether that is before the filing of ITR.
No, it has to be after the filing of ITR. Before the filing of ITR. No, yes, the payment is done before the filing of ITR.
So the rule 6G clause 3 clearly says that you can revise it before the end of the relevant assessment year. Before the end, however, the revision section of section 139 says that it is to be revised on or before 31st of December for the relevant assessment year. So the last date of revision is 31st of December for any assessment year. However, for clause 3 of 6G says before the end of the relevant assessment year. So you can revise the tax audit report up to the end of the relevant assessment year, as per my understanding.
Thank you. So if any taxpayer is following presumptive scheme, but he is disclosing all the details in other law compliances because of mandatory stat compliances other than direct taxes like GST, PF, PSI, etc., then can assessee still claim that books are not maintained under direct taxes?
So the requirement to not maintain books of accounts or maintain books of accounts and the fact that I'm maintaining books of accounts are different. The question that we were trying to answer is there a mandate on me to maintain books of accounts? And the answer in the presumptive setup was no. Despite it, I'm still going ahead and maintaining books of accounts is a welcome activity. Nobody's going to dispute on that.
So next query is that we will provide the citations later on. We will do that. And this question is directed to Deepak Ji that Deepak Ji's comment income exempt under section 10 to audit, but section 11 is subject to conditions.
Yeah, it is certainly a litigative call to take that 44AB is not going to be applicable to section 11 entities. It's definitely not easily going to be accepted, particularly when ICI itself has taken a view that audit has to be done even for section 11 entities. So a call has to be taken with the client. Audit fee bharna hai ya appeal fee bharna hai.
So I think we are done with this. So over to you, Harpreet Ji and Chairman Sir. Thank you so much to all the panelists. Thank you so much for being so patient.
Thank you so much.
Thank you.
Really enjoyed the session. Thank you so much.
I'm really thankful to the moderator who has herself said that thank you. In fact, she has taken my job here, and I was supposed to give the thanks to all the panel speaker here. So my thanks to Deepak Ji, who had chipped in the last moment here. But yes, seeing the depth of the knowledge and the depth of the contribution and the depth of the discussion, I'm really impressed here. Thanks, Pankaj Ji, which is really wise word that I have understood here. I'm not a person, sir, who do the tax audit, but I just try to understand here. I'm the learner here. You people are the great here. And thank you, Sachin ji. Thank you, Smita ma'am. And I will tell you all the participants here. In fact, it was all the credit goes to all these four person, all these 4%, because they were working sincerely since last 3-4 days. And in fact, yesterday we had a similar session that took more than this time here to get prepared so that we can deliver our best to all the participants. And it is the motto and the objective of the Chamber of Tax Consultants, and we are trying to do the same here. It is only for the knowledge dissemination process that we do. And I'm really thanks that young team. I will say that it is the young team, very young team and new team that we have trying to develop here, so that we can have a very good panel of speakers now. Now we have identified the talent in our own group here. In fact, Deepak ji, Pankaj ji, and Sachin ji, all group talent here. Smita ma'am, a big talent in our own group here. And we are confident that we have safely landed the Chandrayaan-3 on the darker side of the moon here. And next time, it is the time for the Suryayan Aditya-1. We have already started here. And so it's very great time, man. And I hope Sarma Sahib is there. Sarma Sahib, if you are still there, Sarma Sahib has raised his hand here. Okay.
Sure. Should I allow him to talk?
Yeah, please.
Yeah.
Sarma Sahib is there.
Yeah.
Sarma Sahib?
Yes, sir. Yes, we have unmuted him, sir.
Sarma Sahib is head of the technical committee of the Chamber of Tax Consultants on the direct tax. Whenever there is a discussion, I'm really blessed by him. Whenever there is a discussion, he participates here. So it is very great. It is great to see him here. Anyway, not taking too much time. It is already 10 minutes past the 7:30. I'm again extending our vote of thanks to all the learned speaker, Smita ma'am, our colleagues, Harpreet ji, all the office bearer of the Chamber of Tax Consultants Delhi chapter, and also the CTC Bombay team who has supported us like anything here, to them also. With this, thanks a lot. Thanks a lot.
Thank you.
Thank you.
Thank you, sir. Thank you for inviting us. Thank you for this opportunity. Thank you, Smita ma'am. Thank you, Sinaji. Thank you, Pankaj ji and Sachin ji. It was a wonderful experience. Thank you all the participants for this very patient hearing. Thank you.
Thank you so much.
Thank you.
You can end the session.